webinar. And today topic is the risks of financial contagion in Asia, which is sponsored by Economic Cooperation and Integration Division, and also RCI thematic group in the ADB, Asian Development Bank. As we know, let me introduce today's webinar. As we all know, global economy is on the brink of a recession. Unabated spread of the COVID-19 pandemic has forced many governments to impose lockdown measures, which have shut down factories, disrupted supply chain, and destroyed the production growth globally with huge jobs and economic losses. In the face of mounting uncertainty, consumer and investment demand have also weakened, pulling down growth prospects for this year. Expectedly, financial fragility in the banking system is therefore one potential consequences of the pandemic. A pandemic-induced economic slowdown implies slower corporate earnings and higher unemployment, exacerbating the debt service burden for both firms and households. Many corporates and micro, small, and medium-sized enterprises, from airlines to retailers to restaurants, face risk of default. Growing job losses also imply a rising household debts and mortgage defaults on the horizon. The banks that lend to them will likely suffer loan losses and rising non-performing loans in short NPLs. This is a topic that we will lengthily discuss today with three esteemed panelists. Dr. Seon Park, Director, ERCI, Economic Research and Cooperation Integration Division, Asian Development Bank. Dr. Kwang Ho Shin, Professor, Korea University. And Dr. Eli Lemorona, Professor of Finance and Director of Central Banking at Asian School of Business. Let me just remind participants to keep your microphone muted while our panelists speak, and also please use the wave hand button or the chat box to raise your hands for questions. And also you can enter your questions in the chat box. The risks of financial contagion in Asia during the open forum. Without further ado, let me call on Dr. Seon Park to deliver policy presentation about the policy brief on the caption, the topic. Seon, the floor is yours.
Thank you, Dr. Sawada. Welcome to the webinar. In fact, we have recently published this policy brief on the impact of non-performing loans on cross-border lending. Many studies have already discussed a lot of adverse impacts of non-performing loans on domestic economies, but the paper studies have been relatively limited to investigate the role of NPLs in cross-border lending. So together with my co-author, Dr. Kwang Ho Shin, we will today present this study and then also share the main findings first. So I'm going to turn it over to Professor Shin to quickly summarize the paper and then share the findings.
Okay, thank you very much for giving me a chance to present the paper. And this is a joint work with Shin Park. Can you see my mouse moving around? My mouse?
Yes.
Sure.
We can see your
okay.
Yeah.
Okay. So the title is The Impact of Non-Performing Loans on Cross-Border Banking Lending, Implications for Emerging Market Economies. And in this presentation, we will highlight the interconnectedness of the global financial system and its risk for emerging market economies. And this can be more vividly seen during the global financial crisis. And everybody knows that shocks originated from financial frictions in advanced economies, but they were rapidly transmitted to emerging economies during the global financial crisis. The reason is that even though banks in advanced countries were hit directly by the deterioration of subprime loans, but they were forced to search for liquidity. And as the market for short-term loans dried up, they had to withdraw funds from emerging market economies. But from the perspective of emerging market economies, this is exactly the capital outflows from their countries. So this episode shows the danger of the interconnectedness of the global financial system and how shocks in one or more financial centers transmitted to other economies. And we believe that these negative externalities from advanced countries can be disproportionately high if the troubled banks are larger and are more interconnected. So this graph shows the recent development of US dollar denominated cross-border bank holdings by non-US banks. This blue part is the Asia, and you can see that the share increases very rapidly recently. And this blue, light blue is EU countries. Now the share of Asian countries surpasses the share of EU countries, and the magnitude is actually even higher than the peak of EU countries before the global financial crisis. Actually, this is the previous study. I also wrote one paper with Senior, and in that paper, we compute direct and indirect exposure of emerging economies to crisis countries and show that during the global financial crisis, emerging economies with high exposures to those countries suffered more of capital outflows. And more recently, I also wrote another paper with Il-hyuk Shim, and this paper actually focused not only during the financial crisis, but even after the global financial crisis. What happens to the capital flows and how they are related to financial stress in advanced economies. I'll go back, return to this issue in a minute. So in the paper with Shin-Young Park, we calculate direct exposure, and that is the actually the summation of share of country I. And country I is emerging economies, how they are exposed to crisis countries J. So we sum up the share of foreign claims held by country J, which suffers from crisis. So CT is the set of countries in crisis. So graphically, you can see that this is emerging economy. Then if they are exposed to crisis countries like red dots here, then if those shares are high, they suffer from more capital outflows because these countries in crisis actually withdraw more from emerging economies. And we also calculate indirect exposure, but I think it's better to use the graph to see the importance of indirect exposure. In this indirect exposure, we actually also consider this lender country, which was not in crisis, but they actually also suffer from capital outflows because they were exposed to other lender countries. So these other lender countries can influence on emerging economies through this non-crisis country indirectly. So we actually calculate this kind of indirect exposure as well, and found that they are also significant in explaining capital outflows from emerging market economies. And more recently, I also wrote another paper with Ilyak Shim, and in that paper, we actually calculated not just crisis, but the financial stress measure based on three proxies: the corporate bond spread, sovereign CDS spread, and bank CDS spread. And we found that not only during the global financial crisis, but even after the GFC, if advanced countries have high financial stress, they withdraw more capital from emerging economies. So if emerging market economies are exposed to advanced countries which had high financial stress, they suffer from capital outflows. Okay, so in this paper, in this policy brief, we used a different measure of the financial stress actually, and we used NPL ratio. So we calculate NPL ratio, average NPL ratio of banks in advanced countries as well as in emerging economies, and this the study covers 26 BIS reporting lenders and 67 emerging market economies, and in this paper we actually also divide countries into four regions: Asia, Europe, North and South America, and Africa, and see how regional lenders behave differently from other region lenders. And let me skip the data. This is very standard data. We actually used CBS and LBS, but we believe that CBS data are more relevant for this kind of exercise. So this is the country grouping. So this is the Asia and Oceania. We have reporting countries and emerging market economies. And in Europe, we also have reporting countries and emerging market countries and so on. Okay, so the basic empirical methodology is this. So this is the capital outflow, which is calculated from foreign claims, difference in foreign claims. So this is the capital outflow from emerging market economies I to lender country J. So basically we use bilateral capital outflow, and that depends on NPL ratio in country J. This is lender country, and NPL ratio in country I, which is the borrower or emerging market economy. And we actually also controlled country characteristic of emerging market economy and aggregate time fixed effect and so on. So this is the result. You can see that this the first line is the coefficient for non-performing loan ratio in country 1, which is lender country. So they are all very significant, and even the coefficient is even larger. So this is on CBS, and you can see that even based on this is LBS, and you can see basically similar results even based on LBS. And in table 2, we actually regress the same equation based on subgroup of lender countries, which are called internationally more active lenders, and their behavior is similar, but this coefficient is even larger, which means that they are more sensitive to their own non-performing loan ratio. This is based on LBS, but the results are a little bit weaker. But as I said, I believe that results based on CBS are more relevant. And finally, in this regression, actually I added region dummy. So this is region dummy, and this is interaction between non-performing loan ratio. And you can see that region dummy is all negative and highly significant. And this interaction term only for lender country, the interaction term is significant and actually positive, which means that these lender countries are even more sensitive if they belong to the same region. So let me briefly summarize all the findings. So we find that international banks withdraw funds from emerging market economies in response to the increase in NPL ratio, and they also depend on both NPL ratio of advanced and emerging market economies. But our results imply potentially more significant and larger effects of banking outflows from emerging market economies if the NPL ratio of advanced economies increases. So the coefficient, as I showed you, is even larger. And we also found that the estimation results using the sample of internationally more active investors show even greater impact of NPL ratio. And when we divide the lenders and emerging economies in different regions, we found that banking outflows from emerging market economies are driven by the same region, lenders on average are lower, 4% or 7% lower, but the sensitivity is actually higher if the lender belongs to the same region. So as I thought at the beginning, we think that this is worrisome, especially for Asian countries, because the share of Asian countries in global bank lending is getting higher recently. And I show that as the share of European countries is shrinking, the share of Asian countries is even higher than that of European countries. So let me stop here and ask the Xinyoung to continue.
Please unmute your microphone.
Okay. Oh, I'm sorry. My microphone was muted. So, the finding actually shows that the importance of addressing the NPL much quicker, and then also addressing the NPL issues are going to be going beyond the domestic issues. So I'm going to talk a little more on the policy implications, and then also applications of findings in the COVID period. Well, the COVID-19 definitely have dented economic outlook, and then in turn it actually deems the outlook for corporate revenue and then earnings prospects. The Bloomberg data shows that the corporate earnings really estimated to decline over the next couple of years, in fact. And then what you see is that the U.S. and then the Euro area do get heavily affected by this COVID, which has implication of a strong sort of financial spillover through the global banking network. The highly leveraged firms face even greater debt service risks. And then corporate defaults are already on the rise. Altogether, S&P's, Moody's, and Fitch ratings all now estimate that the corporate default rates are going to be up. They already show some countries spike in the corporate default rates in April and May, especially affecting the speculative grade. It's now rising in the US, 4.7% default rates. The Moody's especially estimated the Asia Pacific high yield corporate default rates will rise to over 9% by the end of 2020. This creates a significant risk outlook for the region. Okay. So, what we have also seen is that the unwinding of carry trades by the global investors do lead to a massive capital flow reversals in emerging Asia. There was a significant dip in March. The portfolio investment flows were reversed, and the fear of economic recession in March before it has stabilized in April, May. The concern is the world economy has entered into this COVID crisis period in already heavily indebted status. The debt has risen significantly higher. Over the past decade or so, the world economy has seen the extraordinarily low interest rates. And these very low interest rates have triggered global investors to search for yield. And there have been heavy leveraging and then debt flows to emerging market economies. In emerging market economies in general, but in emerging Asia in particular, we have seen a sharp increase in debt. In the private sector especially, driven by the household and the non-financial corporate sector. The orange shade and then the blue shade actually show these private sector indebtedness that have increased significantly over the past decade. The NPLs, by the World Bank figure, have reached 692 billion in emerging market economies. This is a 2.5 times higher compared to 2009. But the private sector estimates are even greater. In fact, the Deloitte estimates that NPL stocks held by banks across the region, Asia Pacific, reaches 640 billion. Currently, the NPL in the region accounts for about 40% of the global non-performing loans. The stylized facts actually show that NPLs do present a significant risk to the post-crisis recovery. Recent IMF study investigated 88 cases of financial crisis in 78 economies since 1990, and they have found that NPLs and a prolonged economic downturn are strongly, significantly, positively related. So the NPL issues are really a risk to the significant corporate debt overhang that tend to delay post-crisis recovery, and also it depresses the corporate investment. So what could be the policy options? First, the macroeconomic stimulus policies. Many countries in the world, in fact, have introduced the monetary and then fiscal stimulus packages already. The sizes are quite significant. But what is really important is how these are going to be spent. They have to the best scenario for world and Asia is that these macro stimulus packages work and engineer a swift economic recovery. That tends to lower the likelihood of defaults and improve the quality of debts, therefore avoid a rise in NPLs. So even before seeing a rise in NPLs, the policymakers should try to avoid massive defaults and also prevent the rise in NPLs. The early actions to address the problem debts are going to be quite important, and then in that sort of action, we can consider the joint ventures or special purpose vehicles to assist the debt restructuring and resolution of the corporate sector debt. The countries have actually a bit of a problem to do these things because many developing countries, especially in Asia, do not have functioning distressed asset markets, except very few countries. So developing these distressed asset markets are going to be quite important. It's a key that will allow banks and then financial institutions to dispose NPLs more quickly and also more effectively to avoid the buildup of NPL in the banking system. And our findings in general do suggest that even when the emerging market economies, banking systems are still healthy, there are risks of financial contagion from advanced economies when the NPLs or the financial sector health deteriorates in those economies. So it does underlie the importance of a stronger regional and even global financial cooperation to safeguard financial stability. Let me quickly go over some elements for successful NPL resolutions. The NPLs can be resolved by three sort of different elements collectively. There has to be bank-driven methodologies that the board members and then the bank themselves have to be incentivized to offload bad loans. To do so, they should be much more, the functional and then effective legal and institutional framework to support the distressed asset markets. There have to be a buyer out there to be able to allow the banks to offload these non-performing loans. And market-driven, the approach are also taken quite frequently, especially in Asia, through the asset management companies to facilitate these the resolution of NPLs. So we can, if there's any questions on the details, we can discuss later in the panel. So this wraps up my presentation. Thank you.
Thank you very much, Kwon-Oh and Seon, for a very clear presentation. Quickly, I think few points very important from presentation. I think goods and service cross-border trade and spillover, negative spillover effect through a supply chain network, we started discussing at quite at length. But at the same time, today's presentation made it clear direct and indirect exposures to the crisis and negative externalities arising from cross-border bank financial transaction. That's a really a critical channel to mitigate potential financial crisis. As we all know, almost all the governments started packaging large-scale stimulus in the fiscal and monetary policies. So each country devoted a critical role and efforts to remove the sign of financial crisis. But today's presentation make it clear it's not necessarily enough, especially if a developed country entered in distressed corporate debt and turn into the financial crisis. That can make a substantial spillover, negative spillover effect to emerging economy. So that's really a core finding of this analytical result. And as also Sion said towards the end, not only domestic policies, macroeconomic stimulus policies to remove this risk of a financial crisis, reaction, and preemptively undermine corporate defaults and looming NPL. These are not to mention very important, but at the same time, stronger regional financial cooperation is indispensable to avoid the financial crisis and safeguard financial stability. And also developing distressed asset markets, special purpose vehicles can be established to tackle at the early phase this looming NPL and distressed assets. So I think we had a very good stage set.